This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Robert Wenzel joining us this morning. Robert is editor and publisher of economicpolicyjournal.com and Target Liberty, is also host of a weekly podcast, The Robert Wenzel Show. Welcome.
Hi, Gordon. How are you?
Well, Happy New Year to you, and I hope 2015 is going to be a prosperous one for all of us.
I hope so. It's good. You know that the Fed is always going to make it tricky for us, but let's see what we can do this year.
Yeah, well, it's even close to last year, but it was pretty easy last year because you knew what the Fed was going to do. Now I'm not sure they can do quite what they think they're going to do, but time will tell. Robert, because this is the first time you've been on the show, could you give our listeners a brief overview of your background and your current involvements?
Okay, sure. Right now, my main focus is on economicpolicyjournal.com, which I've been publishing for about 6 years. That focuses on the economy and finance. I've also got a website called targetliberty.com, which is more involved with libertarian political views, libertarian thoughts, and directions moving towards liberty. My background is basically in finance. Most of the economics that I've studied, I have an undergraduate degree in economics, but for the most part, it's been self-taught. Comes from what's known as the Austrian School of Economics, and that's generally not very popular right now in mainstream university teaching. So a long time ago, when I was a young kid, I had the opportunity to look at different graduate programs, and I realized I'd have to waste my time studying a bunch of Keynesian economics that I really wasn't too interested in, and that the Austrian stuff that I wanted to learn, I'd have to study on my own. So I decided, well, if I'm going to have to study the Austrian school stuff on my own, I might as well make some money while I'm doing it. So I headed out to Wall Street, worked with different hedge funds and money management firms, and research, did some consulting with regard to finance, and here I am now, very, very happy, moving in a direction that I've always wanted to go into, and that's spending most of my time talking about Austrian school economics, which I believe is the most accurate economic theory out there, especially when it comes to understanding the business cycle and what the central bank is doing and how the economy operates overall.
Robert, we've brought some of the best minds in the world in to talk about financial repression. In not one case did I ever before ask them whether they were of the Austrian school. It was more of their knowledge and understanding. But I got to tell you, almost everybody that's came on has said they're from the Austrian school. So you're part of a growing crowd, it would appear.
Okay,
it sounds
great.
like you were an early person into the belief, or at least the understanding of it.
Well, actually it was. I mean, Gordon, it's interesting, but I actually surprisingly got involved in Austrian school economics when I was, I think, in the 7th or 8th grade. I had was trading foreign currencies back there and buying gold, and I have to credit a book by Harry Brown called "How You Can Profit from the Coming Devaluation" that came out in 1969, 1970. I was a very young guy. I was interested in finance at that time and probably had read maybe 2 standard stock market books, then picked that book up. And of course, that was way before Amazon or the internet or anything like that. And in the bibliography, Harry Brown listed a bunch of Austrian school stuff from guys like Murray Rothbard, a book called What Has Government Done to Our Money? And the Ludwig von Mises books, Human Action and Theory of Money and Credit. Of course, there's an expansive internet presence for Austrian economics, but there wasn't back then. You just sort of had to send the check off to these publishers and hope you got a book back in the mail. And I did. So I sort of mainlined and hardcored at a very early age and continue to read and study the topics today.
Has it served you well in your investments?
Absolutely, no question. I've been able to recognize many of the booms and busts in the cycle. And as a matter of fact, I've got a book called The Fed Flunks, My Speech at the New York Federal Reserve, which is a small book, but it covers the recent financial crash and the fact that I saw it coming in real time, which I covered in Economic Policy Journal. I actually, the summer before the crash actually took place in 2008 in September, when we had the breaking of the buck by the Reserve Fund, I was warning and saying I can't believe the Federal Reserve is doing what it's doing. Money supply has dropped so dramatically. We're going to have a crash and so on and so forth. Well, to make a long story short, which I detail in the book, I was invited to the Federal Reserve in New York, excuse me, to discuss, how exactly I was able to warn about it. And there are a couple of Federal Reserve economists there, one by the name of McCarthy and Peach, who actually earlier on wrote a paper in 2005 saying there was no housing bubble. And I initially caught their attention because I said at that time that not only are they wrong that there is a bubble in the housing market, but they are going to be as wrong as Irving Fisher was in 1929 when he said stocks were the new high plateau before the stock market crashed.
An often quoted phrase, actually. Exactly.
As
a reminder.
Yeah. So I got their attention, and Gordon, you've looked at my site, so I'm quite a character when I write sometimes. So I do definitely get people's attention, and it didn't stop when I got in the halls of the Federal Reserve building, and I let them have it. So
well, I'm glad you did, by the way. But anyway, Robert, we're here to talk about financial repression and as a macroprudential policy. And with your Austrian background, I think it's really appropriate too. How would you define it in your words, and what does it mean to you?
Yeah, basically the way I see it is I see the central banks of the world and the Federal Reserve in particular for people in the United States as manipulating the economy. They manipulate the economy by manipulating interest rates, by manipulating the flows of funds. So it's very difficult for the average person to make money consistently, because 1 minute the trend is going this way, then the Fed shifts and makes it this way. So unless you're following things very closely and understand how these manipulations are occurring, it's very difficult. It sort of represses everybody and creates a major advantage to Wall Street. I'm out here on the West Coast now in San Francisco and in Silicon Valley. There's more to it. There's regulations involved also. If you're a small guy trying to raise money, there are so many regulations. It's impossible to do it. What they do is they put all these regulations on, which make it very difficult, repress people from being able to raise money and start businesses. And it's only the elite that are able to do it. So in San Francisco here, we have the Silicon Valley elite that have tremendous amounts of money. They have tremendous amounts of power. They have tremendous amounts of access to Federal Reserve money. And so it's those companies that succeed, and we get to see the split between those that are able to succeed, able to make a lot of money in the current situation, and the rest of the people who are repressed because of Federal Reserve activities and the government regulations which push all these people out.
Well, a big part of financial repression, there are four cornerstones, but the third is to really ring fence through regulations and regulatories your abilities to make choices, the choices that actually force you into higher risk assets that you have to more or less speculate on. And are you seeing, how many regulation changes are you seeing, or concerns do you have in that regard?
Gordon, there are regulation changes all the time, and the problem is, and I actually talked. I go to some of the meetings that occur in New York and in Washington D.C. with some of these elitist guys, and I had a conversation with one of the top guys at the Carlyle Group, David Rubenstein, who's one of the co-founders. Yeah, and this guy gets around. When George Bush Sr. celebrated his wedding anniversary. I believe it was his 50th at the time. David Rubenstein was the one that gave the toast. Now, recently he was
I would interrupt you to say that George Bush Sr. was also on the board of directors of Carlyle Group, which Rubenstein, just by the way, after he stepped down from being president. But
right, and he had Tony Blair. And
yep.
I think a lot of those guys are still in the background with Carlyle Group, but I think they realized it was a public relations disaster
to
keep them on the board, so you never see their names tossed around. But but he operates with the Democrats also. He was recently at some kind of Obama function and all this. But anyways, I was at a Wall Street Journal event in Washington D.C. and he was there, and there was some kind of legislation going on at the time, and he basically just said to me, I asked him what he thought of it, and he says the devil's in the details, and it's exactly true. What these guys do is they write small little paragraphs that very, very few people understand and can mean tremendous advantages to people. I'm fairly familiar with finance and raising money in the for small companies, and there are laws and regulations that make it very, very difficult for most people to do it, but meanwhile, the people that really know the laws, know how to get around them, have a tremendous advantage and make all kinds of money off of the poor people that just don't know how to operate around those guys. So you just see that in place after place, position after position. The laws are there. There's all kinds of paragraphs there that hurt most people.
And it's so consistent. As example, in the last couple of weeks, the new budget that went through, the omnibus bill, if you read inside it, it actually changes the whole accounting for derivatives, and therefore the liabilities associated with derivatives that Dodd-Frank was center and core to trying to change the risk, but now the taxpayer is on the hook for them, for the banks that are now operating those subsidies. It's completely changed it. The FATCA, which is the Foreign Accounts Tax Control Act around the world, has really basically put capital controls in place for any expat that's trying to operate around the world. And like you, I can just go on. But it's a key part of this financial repression is to, as I said earlier, to ring fence it, to make sure that your tighter and tighter controls or restrictions of what your options are, because the key parts of financial repression are inflation, negative real rates of interest, which forces you into lower yield products, because it's all oriented at paying off the government's debt, as I said, ring fencing, and then the misinformation of data such as CPI, GDPs, the data itself and the measurement systems. Am I correct in those assumptions?
Yeah, absolutely. I agree with you 100%. I mean, it's a rigged system that benefits the elite, and wherever something sort of goes off the rails for them, then they just write new rules, new bailouts. I mean, look at after the 2008 financial crash, we now know that Goldman actually needed the money that was part of that bailout, and it just happens. It will continue to happen. They continue to have tremendous advantages, and it's difficult for the little guy unless you really understand and sort of position in line with those waves to the degree you can. But to actually participate in the financial sector by building a business and trying to raise money and all that kind of stuff, I mean, they have that blocked off. Unless you're somehow connected, unless you have something really, really big that the Silicon Valley people are willing to ride you on, bet on you, it's very, very difficult.
The old school of capitalism is being replaced with what I'll refer to as crony capitalism.
Absolutely.
And using regulatories and regulatory arbitrage as a competitive weapon to build moats around and protect your own monopolies, cartels. Those are ugly words, but let's just say competitive advantage. And with the government getting as large as it is, to actually be able to feed off the government in a bigger way. Is that a correct observation?
Gordon, I'm 100% in sync with you there. There's no question that's exactly what's going on, and again, it just makes it very, very difficult for the average person to survive. I mean, look at the housing bubble. They blew that up, but they got everybody to think housing was the place to be, and everybody owns stuff at the top. People borrowed money at the top, and all those people were destroyed. Lives were destroyed. People lost tremendous amounts of money. And it continues to this day in other sectors, the stock market being one of them right now.
Right. How much do you think our politicians themselves are fully aware of what's going on here? I mean, a lot of this comes from central bank policy. As we said, some of it's regulatory, so it's being passed, but I don't even sure they read these parts of the bills because they get them the night before. Are our politicians naive in general to what's going on, or are they part of this, or do they see it as the only way to finance the debt that the government has, and they're kind of trapped in, this is all we can do?
That's a very good question. I think there are different politicians. I think some of the top guys really understand what's going on. They're just total opportunists, and are attempting to ride the wave and hope a collapse doesn't come while they're in charge of the ship. On the other hand, there's some smaller guys, some congressmen and stuff like that, who really don't understand. They're just confused, and they're taking advantage of it and all that kind of stuff. But the top players know what's going on, and they're just opportunists. You know, the Nobel Prize winning economist, who happened to also be from the Austrian school, Friedrich Hayek, wrote a book called The Road to Serfdom. And in that book, he wrote the worst get to the top, and that's absolutely true, because the guys that are willing to say whatever it takes to get to the top, to sort of appeal to the masses on a very simple, basic level where nothing ever really gets done, are the ones that get to the top. And these guys know what's going on, and they don't care. They're out for themselves.
As the bad get to the top, so bad money forces out good money. And so in the financial community, it's the same kind of thing. So it forces and changes the behavior. I would say, and Austrians would say, as soon as you move off sound money, the controls and the disciplines start to lead to significant changes in behavior, which leads to malinvestment, mispricing of risk, lack of price discovery, etc.
Exactly. All that is going on right now, and again, it's to the advantage of the Wall Street elites like Goldman Sachs. And the real problem comes is it's just hard for a businessman to understand how to develop his skills, because the economy is always fluctuating. It's going through these roller coasters of booms and busts and changes in interest rates. So he doesn't really know. There might be a period of 3 or 4 years that this makes sense and is profitable, then it's no longer profitable. So it makes it extremely difficult for these people to learn how to operate in a stable environment, because there is no stable environment, and the advantage turns to those that are close to the government, where the government will bail them out when a problem develops.
And you see that in capital investment, which has been steadily falling off dramatically. Last quarter, 90% of all profits went into buybacks and dividends. That's not capital investment that's going to create jobs, etc. The financial system is somewhat, not a financial system, the capitalist system is breaking down under this policy, is my opinion. But Robert, where is this leading? Where do you see it going in the next couple of years?
Gordon, it's not going to turn out well.
Happy New Year.
Yeah, exactly. I think the biggest surprises are going to be, everybody's expecting interest rates to increase maybe by the middle of the year, that the Federal Reserve will start to increase, and that may be when they do it. Maybe they do it a little bit earlier. But I think the increases in the interest rates are going to be much higher than people expect. But I also think the big surprise is going to be on the inflation front. Right now, prices are not climbing. The indexes aren't showing a lot of inflation right now, and a lot of that has to do with the oil price. But the oil price is falling for a very complex supply and demand situation with shale oil production here in the United States that will eventually get wiped out at these low prices. Once the oil price stabilizes, excuse me, I'm getting over a little bit of a cold. Once the oil prices start to stabilize, then I think you're going to start even these indexes, which tend to dilute a lot of the price inflation, is going to show strength. But here's the thing: the Fed supposedly had why they have an inflation target in the first place, I think is absolutely insane. But they do have an inflation target of 2%. I actually think the real target is 3%, and they'll think of anything between 2 and 3% as just noise in numbers. So I don't even think they'll be concerned about inflation until it's 3% on their numbers, which dilute the inflation anyways, because as we all know, food and rent and things are going up stronger than that right now. But in addition to the 3%, once they start to get concerned, I think inflation jumps to 5% on these indexes before they even know what to do. And right now, the Fed target rate on the Fed funds is between 0 and 25 basis points. That's less than 1%. If they raise it to 75 basis points, or even 1%, that's not going to stop the inflation. They're going to be in a tiger by the tail situation where inflation is going to heat up, and interest rates are going to go up, but they're never going to increase them enough. So I think we could get into a period much similar to very similar to the late 1970s, 1980s, early 1980s, where you had very high inflation and very high interest rates, and they didn't stop climbing until Paul Volcker came in to slam the brakes on the inflation. We had short-term rates around 16%. So it could be a total disaster. It's a very, very dangerous time.
For some of us that lived through that era and had mortgages coming due and refinancing at 19%, which I was.
Wow.
Remember, and we had no growth. We referred to as stagflation. When you let that inflation genie out of the bottle, Volcker will say it's almost impossible to get it back in. But in regard to inflation right now, trying to get it to 2% or getting it to 3%, at least as reported, inflation is not good for the average citizen. It's not good for pensioners. It's not good for savers with 75 million baby boomers. Workers are not getting 2% increases, but here's inflation going to be at 2 and 3 and higher. That means you're losing ground. How is this good for the public?
It's not at all. It's an economic apologist construction to justify Federal Reserve money printing, which again benefits the elites and benefits the government, not the average person.
But aren't these our elected leaders who are for the people, by the people? Who are they representing then if this is not? So deflation is good for those with large amounts of debt or highly leveraged, is it not?
Exactly. That's why Wall Street people are always leveraged up. And all your major billionaire capitalists really are guys that own a lot of debt. So it pays for them to...
And highly leveraged.
Yeah, exactly. So it pays for them to want the dollar destroyed so they can pay this off cheaply. But the person that's on a fixed income, the person that's retired, the person trying to save some money in a bank, it doesn't help any of them. It's a terrible situation.
Well, we've seen what the communications is such that this is what we have to do. And but somebody seems to be losing the basics of saying, but deflation has always been part of the economy. Matter of fact, the more productive a society is, the more you get more for less, and therefore you actually create deflation. It's a positive benefit of technology advances. Exactly.
Deflation is really it's sort of a great thing. I mean, you think about it. You have it now in certain sectors. You have it flat TV screens, cell phones, computers, desktop, laptop computers, all those kind of things where you really have, technology improving quicker than the prices can catch up. You see those prices dropping, and it's a fantastic thing. If you had that across the economy, it would be great. Every dollar we earn, we could buy more. At the same time, it would cause incentive for us to save money, because when we eventually spent it, it would buy us more. But now all that is reversed, and it doesn't benefit the economy overall. It doesn't benefit us. It just benefits those elite.
Yeah,
And
as my close friend Robert Duncan says, that we don't have capitalism anymore. We have creditism, and so instead of capitalism, is you get more for less. We're getting a lot less for more,
right,
as
right,
it forces into the system right now.
right, exactly, exactly. And getting back to the politicians, they again, the top guys know, the guys on the lower levels. As a matter of fact, when I was at the Federal Reserve and gave my Fed flunk speech, I spoke to a couple of senior economists after my talk, and I discussed with them specifically the Austrian School of Economics. They didn't even know what it was. Okay, so these guys, I mean, that was shocking to me. And then, as a matter of fact, one of them, this is a senior guy at the New York Federal Reserve. I said to him, or he said to me, so I know what you Austrian school guys are. You guys are the ones that have the equation PV equals MT, which is not an Austrian school thing. That's a Chicago school thing, which told me he not only didn't understand Austrian school economics, but he didn't understand Chicago school economics either. And he's one of the top guys at the Federal Reserve. So these guys, they don't know. All they know is money printing, and it's a terrible thing. They have no vision of what's beyond money printing. Any solid Austrian school economist will tell you what the Chicago school is about, what the Keynesians are about, what the Fed is thinking, because we study and we analyze all this stuff. But the Fed people have these blinders on, and they don't know. And then the ones at the top probably know what's going on, but it's for their benefit, so they keep it going.
Well, they kind of get into this, that stimulus spending will help the economy, and in the short term it does, until propensity of money falls off such that a new dollar of spending is actually hurting more than it's gaining, and that's the stage that we're in, my personal opinion. But just make sure I don't leave our listeners with a misperception that I believe we need deflation. If we don't have some level of inflation, the system will implode. And right now, because of the amount of leverage that's in the system, the levels of collateral, and what would happen is we'd have a collateral contagion, and that's one of the reasons why I believe the Fed's caught in a trap right now, because it just can't let asset values fall too far, nor can it afford to allow interest rates to go too high, because we won't be able to afford the debt with $84 trillion of unfunded liabilities and probably close to $10 trillion of unfunded pensions right now between state, federal, and private.
Yeah, Gordon, I agree with you completely, but I'm a tougher guy than you are. I just say let the whole damn thing collapse, wipe all these guys out, and let the conservative people like us who know how to handle money emerge and let a new economy develop after that. But I agree. I mean, it's a house of cards that could collapse at any time, and the Fed is really in a bind. They're just never going to rate. They're going to raise interest rates a lot, but never enough to slow the inflation and all that, and it's going to be a disaster.
Typically, it ends with a currency collapse historically. When you get into a fiat currency, and that's the chance that we have. But we do need things to fall down, because that's when you get repricing, you get malinvestment that's forced out. It's a natural cleansing process, the business cycle, and the longer Kondratyov cycle that we go through. But when you stop that cycle, because we're terrified of the R word, like a recession or anything like this, you stop this healthy process. And I guess it's natural for the politicians not to want this, but it's something like a drug. If you get so used to taking it, you can't get off of it, even when you think you're healthy. Yeah.
See, the problem is that since the 2008 crash, they've had a little bit of a free ride here, because they've pushed interest rates down, but they haven't really seen the inflation, and that's because I consider it, there was fear in the market and people were holding on to the cash balances, so they weren't bidding up prices. But as the economy, quote unquote, improves, this manipulated improvement, people are going to be more willing to spend money. The Fed continues to print enormous amounts of money, and that inflation is going to heat up much faster. The Fed doesn't watch this stuff very closely. They're just trend watchers. They don't understand how something could increase dramatically as far as inflation. They just don't see it. I mean, you look at their projections 5 years out, and they're still talking about 2% inflation. That's absurd. It's going to go crazy. It's going to go through the roof. Now, what I find more remarkable, Gordon, is I read the Fed minutes very, very closely, and also Janet Yellen's Fed the statements that come out of the Open Market Committee. And do you know they do not even mention the money supply in their statements anymore? It's absolutely stunning. Absolutely stunning. They have no clue. They really don't watch it, maybe as a secondary number or something like that. So they're not even going to know how to fight this stuff once inflation heats up. They're just completely off the page, have no clue as to what's going on, and that's really scary. It reminds me, Gordon, you may remember before Volcker, there was a guy by the name of G. William Miller, who was the Fed chairman, and he's the guy that really didn't understand money supply or anything like that, and really got the country almost close to hyperinflation in that thing before Volcker came around and clamped things down. But Janet Yellen is no Paul Volcker, and as a matter of fact, I don't even think she's operating the Fed. I think she's cover for Stanley Fischer, who's the vice chairman. And but if you read his statements, he's an inflationist also. He might be a little more of a conservative inflationist than Yellen, but he's in favor of money printing, and there's just no clue they're aware of what's going to happen, and it's going to be a mess. It really is.
I echo your comments on Stanley Fischer's real role, and he was at the Bank of Israel before he came in. Of course, he's a famous MIT professor who trained a lot people. I believe Bernanke is a classic one of his students in this process through the years.
Yeah, and I think what the problem was that because he's got dual U.S. and Israeli citizenship, and then was head of the Bank of Israel Central Bank. I think they probably felt they would have trouble getting him through the nomination process as chairman, so that's why they put Yellen in. But of course, she goes out.
First thing he did was to talk about financial repression and the macroprudential strategy, and I think his very first speech. And the importance of it, which is the regulatory standpoint. But you know, we were talking about money supply here, and you were mentioning it. I can remember where we all used to pay very close attention of when the numbers came out, and if you might remember something called M3, and how critically important it was. Well, as you know, Bernanke, one of the first things Bernanke did was to remove it as a report, and you don't get the numbers unless you want to talk to John Williams over at Shadow Stats. It doesn't even exist, and we used to. Those were as important as the labor numbers every month.
Yeah, so, you're absolutely right.
So what happened? That's part of this misinformation of taking these things out. And on inflation, they can print all the money they want, but it's the money velocity, and velocity keeps falling. And I agree with you fully. At some point, it'll turn around and it'll go straight up. And that's when you'll see inflation, and then it'll follow with hyperinflation. But why it'll turn will be fear. And why? Because people wanting to get out of the money because of some concerns with currency. And typically it's been because of inflation. It's not a store of value, your currency. But it'll happen, and it'll happen abruptly. Maybe when the $2 trillion of excess reserves that are at the Fed from the bank are pushed out.
Right, exactly. Gordon, I'm in complete sync with you on that. I mean, the velocity's been dropping for years, but you know, the last 2 quarters it's stabilized. It's no longer dropping.
Yes, it's flat.
So, you know, it's at some point, you know, that flips, and when that velocity heats up, that's it. Then the inflation is off to the races. And you're absolutely right about. I mean, I can remember how markets used to react to the money supply numbers, the bond markets and the stock markets when those were announced. As a matter of fact, in the early 1980s, the number was actually announced during the trading day, and they had to change that because there was so much volatility after the number was announced. But somehow that number is no longer watched, and it's utterly remarkable. I mean, I watch it. I calculated. I have my own little unique formula where I tweak it a little bit, but I calculate it every week, and it's very high. The latest number, which I just put out today, I have something called the EPJ Daily Alert, which I put out to investors, and it's at 7.5%. This summer it was as low as 2.8%. So there's a lot of money sloshing around right now, and if that velocity ticks up, watch out. Prices,
it will, when it happens, it'll be violent. It'll be violent.
Yeah.
But
I agree.
But it'll be a loss of confidence. And all of a sudden, maybe we'll start to realize the emperor had no clothes after all, or that this printing and expansion of the money supply, the balance sheet of the reserves is not, Federal Reserve, central banks, is not the solution. And clearly Japan has shown the way here.
Right.
So we're running up against a hard time. We're just beginning this discussion, Robert. It's a great one. Closing messages for our listeners, things that you'd really like to leave with them of what's in front of us and what they should do about financial repression as an investor.
Okay, well, I tell you, I mean, obviously, gold, silver, things like that are really, really very, very good investments right now. I don't think there are very many people that fear that you and I fear that's coming, so I consider them extremely undervalued investments. I would make them the core of any investment. I think it's sometime in 2015 the price of oil is going to stop going down, and that's going to reverse. So I don't think you have to get fancy in the oil market here. Just buy the majors like Mobil, Exxon. That's a little more of a risky kind of investment, but I think there's potential there. But gold and silver as the basis, and what you want to avoid completely at this time is holding long-term bonds. They're the absolute worst investment. You're going to lose money even if whatever bond you have doesn't default or collapse or something, and you get your money back in 10 years. It's going to be worth so little in purchasing power that it's not worthwhile. So buy the inflation assets, especially gold and silver. I'm going to make a quick comment here about silver versus gold. I like them both. I think they're both going to explode. But I had a conversation with Ron Paul about 3 or 4 years ago, and he felt that silver percentage-wise is going to increase more than gold because gold is going to go so high that the average person won't be able to buy it, so they're going to switch to the silver, causing the percentage gains in silver to be good. So I think central banks like Russia and China are buying gold and will continue to do so. So that's going to be a major, but there's also real good reasons to own silver, but stay away from the bond market.
Great advice. And Robert, I appreciate you on. I appreciate your honesty. And we have to have you back again in 2015 to compare how these things are unfolding. And the rate and the speed at which it's happening, because clearly it's going to be a very exciting year.
I'm with you 100% on that. Thanks for having me, Gordon.
Talk to you
Take
again.
Care.
Bye.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.